We shall commence this module by discussing about the structure of interest rates. The term structure of interest rates describe the differing yields to maturity (YTM) on similar debt securities, with yields typically being higher than the longer the period until maturity. For instance, a US Treasury bill with a 6-month maturity might carry a 4.5% yield, while a 30-year Treasury bond bought at the same time may yield a 5.5% return. When such a difference exists, it is known as the term premium. In the United States, Treasury securities are generally used to map the term structure of the interest rate, that is the yield curve, because they are virtually free of default risk. However, term structures may be compounded and analyzed for any number of interest-bearing instruments. The term structure of interest rate is the variation of the yield of the bond with the similar risk profiles with the terms of those bonds. The yield curve is the relationship of the yield to maturity of the bonds to the time to maturity, or more accurately to duration, which is sometimes referred to as effective maturity. In most cases, bonds with the longer maturity have higher yields. However, sometimes the yield curves becomes inverted, with short-term notes and bonds having higher yields and long-term bonds. Sometimes the yield curve may even be flat, where the yield is the same regardless of the maturity. The actual shape of the yield curves depend upon the economic conditions, fiscal policies, expected forward rates, inflation, foreign exchange rates, foreign capital inflows and outflows, credit rating of the bonds, tax policies, and the current state of the economy. The term structure of the interest rate has three characteristics. The change in the yields of the different term bonds tend to move in the same direction. The yields on the short-term bonds are more volatile than the long-term bonds. The yield on the long-term bonds tend to be higher than the short-term bonds. After studying this module, you shall be able to know about what is the term structure of the interest rate, know about the importance of the term structure analysis, understand various theories of the term structure of interest rate. Let us now discuss the importance of the term structure analysis. Economists and the financial analysts employ term structure analysis, which frequently involves creating or using mathematical models for a variety of applications. Some of the most common include forecasting future interest rate, estimating the cost of capital for discounting future cash flows, building predictive models of the general economic growth, example to the project domestic product, formulating monetary policy, estimating future inflation, understanding dynamics in the financial markets, constructing a portfolio or a hedging strategy. The shape of the term structure may change from period to period, being either upward sloping, that is long-term rate higher than the short-term rates, downward sloping, that is long-term rates lower than the short-term rates, or flat, long-term rates equal to the short-term rates. Most frequently, however, the term structure is upward sloping. In addition to the direction of the slope, term structure analysis is concerned with the steepness of the slope at any particular time, where a greater slope signifies a larger disparity between the interest rate over some period of time. Moving on to understand the term structure of interest rate theories. Of all the factors that affect the yields offered on the debt securities, the factor that is most difficult to understand is the term to maturity. For this reason, a comprehensive explanation of the relationship between the term to maturity and annualized yield, referred to as the term structure of interest rate, is necessary. Various theories have been used to explain the relationship between maturity and annualized yield of the securities, including the pure expectation theory, liquidity, premium theory, and segmented markets theory. Each of these theory is explained here. Pure expectation theory. According to the pure expectation theory, the term structure of the interest rates as reflected in the shape of the yield curve is determined solely by the expectation of the future interest rate. Impact of an expected increase in interest rates. To understand how interest rate expectations can influence the yield curve, that assume that the annualized yields of the short-term and long-term risk-free securities are similar, that is, the yield curve is flat. Then assume that the investors begin to believe that the interest rates will rise. They will respond by investing their funds mostly in the short term so that they can soon invest their funds at the higher yield after interest rate increase. When investors flood the short-term market and avoid the long-term market, they may cause the yield curve to adjust. The large supply of the funds in the short-term market will force annualized yield down. Meanwhile, the reduced supply of the long-term funds forces long-term yields up. Even though the annualized short-term yields become lower than the annualized long-term yields, investors in the short-term funds are satisfied because they expect interest rate to increase. They will make up for the lower short-term yield when the short-term securities mature, and they reinvest at a higher rate if the interest rate rise at a maturity. Assuming that the borrowers who plan to issue securities also expect interest rate to increase, they will prefer to lock in the present interest rate over a long period of time. Thus, borrowers will generally prefer to issue long-term securities rather than the short-term securities. This results in relatively small demand for the short-term funds. Consequently, there is a downward pressure on the yield of the short-term funds. There is also an increase in the demand for the long-term funds by the borrowers, which places upward pressure on the long-term funds. Overall, the expectation of the higher interest rate changes. Demand for funds and supply of funds in different maturity markets, which forces original flat yield curve labeled YC1 to pivot upward counterclockwise and become upward sloping YC2. Next, we will discuss the impact of an expected decline in interest rate. If the investors expect interest rate to decrease in the future, they will prefer to invest in the long-term funds rather than the short-term funds, because they could lock in today's interest rate before interest rates fall. Borrowers will prefer to borrow short-term funds so that they can re-borrow at a lower interest rate once interest rates decline. Based upon the expectation of the lower interest rate in the future, the supply of the funds provided by the investors will be low for short-term funds and high for the long-term funds. This will place upward pressure on the short-term yields and downward pressure on the long-term yields. Overall, the expectation of the lower interest causes the shape of the yield curve to pivot downwards clockwise. Expectation about the future rate interest. If it is higher than the today rate, then the structure of the yield curve would be upward slope. If it would be the same as today's rate, the structure of the yield curve would be flat. If it is lower than the today's rate, the structure of the yield curve would be downward slope. Next is the liquidity premium theory. Some investors may prefer to own short-term rather than the long-term securities because a short-term maturity represents greater liquidity. In this case, they may be willing to hold the long-term securities only if compensated with a premium for the lower degree of liquidity. Although long-term securities can be liquidated prior to the maturity, their prices are more sensitive to the interest rate movements. Short-term securities are normally considered to be more liquid because they are more likely to be converted to the cash without a loss in value. The preference for the more liquid short-term securities places an upward pressure on the slope of the yield curve. Liquidity may be more critical factor to the investors at the particular points of time, and the liquidity premium will change over the time accordingly. As it does, so will the yield curve. This is the liquidity premium theory, also referred to as liquidity preference theory. The exhibit combines the simultaneous existence of the expectation theory and the liquidity premium. Each graph shows different interest rate expectation by the market. Regardless of the interest rate forecast, the yield curve is affected in a somewhat similar manner by the liquidity premium. Now, we will discuss the another theory, that is segmented markets theory. According to the segmented markets theory, investors and borrowers choose securities with maturities that fulfill their anticipated needs of cash. Pension funds and life insurance companies may generally prefer long-term investments that coincide with their long-term liabilities. Commercial banks may prefer more short-term investments to coincide with their short-term liabilities. If investors and borrowers participate only in the maturity market that satisfy their particular needs, markets are segmented. That is, investors or borrowers will shift from long-term market to short-term market and vice versa only if the timings of their cash needs changes. According to the segmented market theory, the choice of the long-term versus short-term maturities is predetermined according to the need rather than the expectation of the future interest rates. For instance, assume that the most investors have funds available to invest only for a short period of time and therefore desire to invest primarily in the short-term securities. Also, assume that the most borrowers need funds for a long period of time and therefore desire to issue mostly long-term securities. The result will be downward pressure on the yield of the short-term securities and upward pressure on the yield of long-term securities. Overall, the scenario described would create an upward sloping yield curve. Now consider the opposite scenario, in which most investors wish to invest their funds for a long period of time, while most borrowers need funds for only a short period of time. According to the segmented markets theory, there will be an upward pressure on the yield of the short-term securities and downward pressure on the yield of long-term securities. If the supply of the funds provided by the investors and the demand for the funds by the borrowers were better balanced between the short-term and the long-term markets, the yields of the short-term and long-term securities would be more similar. A limitation of the segmented markets theory is that some borrowers and savers have the flexibility to choose amongst various maturity markets. Corporations that need long-term funds may initially obtain short-term financing if they expect interest rate to decline. Investors with the long-term funds may make short-term investment if they expect interest rate to rise. Some investors with the short-term funds available may be willing to purchase long-term securities that have an active secondary market. Some financial institutions focus on a particular maturity market, but others are more flexible. Commercial banks obtain most of their funds in the short-term market, but spread their investment into short, medium and long-term markets. Saving institutions have historically focused on attracting short-term funds and lending funds for the long-term periods. If maturity markets were completely segmented, an adjustment in the interest rate in one market would have no impact on the other markets. Yet, there is a clear evidence that the interest rate among the maturity market move closely in tandem over time, proving there is some interaction among markets, which implies that the funds are being transferred across markets. Note that this theory of segmented markets conflict with the general presumption of the pure expectation theory that the maturity markets are perfect substitute for one another. Although markets are not completely segmented, the preference for the particular maturities can affect the price and the yields of the security with different maturity and therefore affect the yield curve's shape. Therefore, the segmented markets theory appears to be a partial explanation for the yield curve's shape, but not the sole explanation. A more flexible perspective of the segmented market theory, called preferred habitat theory, offers a compromise explanation for the term structure of the interest rate. This theory suggests that although investors and borrowers may normally concentrate on a particular natural maturity market, certain events may cause them to wander from it. For example, commercial banks that obtain mostly short-term funds may select investment with the short-term maturities as a natural habitat. However, if they wish to benefit from an anticipated decline in the interest rate, they may select medium and the long-term maturity instead. Preferred habitat theory acknowledges that the natural maturity markets may influence the yield curve, but recognizes the interest rate expectation could entice the market participants to stray from the preferred maturities. Integrating the theories of the term structure. To illustrate how all three theories can simultaneously affect the yield curve, assume the following conditions. Investors and borrowers who select security maturities based upon the anticipated interest rate movements currently expect interest rate to rise. Most borrowers are in need of long-term funds, while most investors only short-term funds to invest. Investors prefer more liquidity to less. The first condition related to expectation theory suggests the existence of an upward sloping yield curve, other things being equal. This is shown in the exhibit as curve E. The segmented markets information condition 2 also favors the upward sloping yield curve. When condition 1 and 2 are considered simultaneously, the appropriate yield curve may look like curve E plus S. The third condition relating to the liquidity would then place a higher premium on the longer term securities because of their lower degree of liquidity. When this condition is included with the first two, the yield curve may look like curve E plus S plus L. In this example, all the conditions place upward pressure on the long-term yields relative to the short-term yields. In reality, there will be sometimes be offsetting conditions, as one condition places downward pressure on the slope of the yield curve while the other places upward pressure on the slope. If condition 1 was revised to suggest the expectation of the lower interest rate in the future, this condition by itself would result in a downward sloping yield curve. When combined with the other condition that favor an upward sloping curve, it would create a partial offsetting effect. This yield curve would exhibit a downward slope if the effect of the interest rate expectation dominated the combined liquidity premium and segmented markets effect. Conversely, an upward slope would exist if the liquidity premium and segmented markets the effect of the interest rate expectations. Let us understand the implication of the yield curve for the yield curve theories. First is pure expectation theory. According to this theory, a rising term structure of the rates means the market is expecting short-term rates to increase. So, if the 2-year rate is higher than 1-year rate, rates should rise. If the curve is flat, the market is expectant that the short-term rates will remain low or hold constant in the future. A declining rate term structure indicates the market believes that the rate will continue to decline. Second is liquidity preference theory. Under this theory, the curve starts to get a little bit more bent. With an upward sloping yield curve, this theory really has no opinion as to where the yield curve is headed. It could continue to be upward sloping, flat or declining, but the yield premium will increase fast enough to continue to produce an upward curve with no concern about the short-term interest rates. When it comes to the flat or declining term structure of the rates, this suggests that the rates will continue to decline in the short end of the curve given the theory's prediction that the yield premium will continue to increase with maturity. Third is the market segmentation theory. Under this theory, any type of yield curve can occur, stretching from the positive slope to an inverted one, as well as a humped curve. A humped curve is where the yield in the middle of a curve are higher than the short and the long ends of the curve. The forthcoming shape of the curve is going to be based on where The investors are most contented and not where the market expects yield to go in the future. Let us recapitulate what we have learned so far in this module. According to the pure expectation theory, the term structure of interest rate as reflected in the shape of the yield curve is determined solely by the expectation of the future interest rates. According to the pure expectation theory, the term structure of the interest rate as reflected in the shape of the yield curve is determined solely by the expectation of the future interest rates. Liquidity may be more precarious aspects to the investor at particular points of time, and the liquidity premium will change over time accordingly. According to the segmented market theory, investors and borrowers choose securities with the maturity that satisfy their forecasted cash needs. A more flexible perspective of the segmented market theory, called preferred habitat theory, offers a compromise explanation for the term structure of interest rates.